Welcome to Startup Sim. In this tutorial, we will be looking at the other side of the balance sheet, namely the liabilities and equity. The liabilities is primarily the list of debt that a company has and is carrying. And then the equity is the value of the investment made by shareholders or the value that it has created. Liabilities are made up of account payable, just like we had account receivable, which was money that the company will receive in the following periods. There are also payments that are due by this company in the upcoming periods. In period 9, this company will have to pay $883,000 to a number of partners and $300,000 in period 10. If you do not have enough money at the end of the quarter, enough cash, as we saw this company had a zero cash in the assets, it often is because the bank has used up all the cash that you had in your bank account and then has extended an emergency credit called supplier credit, which is a loan, an expensive loan that was necessary to honor your debt. So this company has a supplier credit, but they have no bank loan, which is probably a mistake, certainly a mistake, because they could have received a loan, an area bank loan, which is typically a lot cheaper than a supplier credit, nearly 3 times cheaper or 2.5 times cheaper. All of these debt, account payable, supplier credit, area bank loan, form together the current liability, $3.8 or $3.9 million. This line is also important because it is part also of the calculation of the possible bank loan that you would be allowed to obtain. Namely, the system will count the difference between your total current assets and your total current liability and apply a certain ratio, which is specified in the user guide, 70 to or 80 to 60% depending on the region, and then you are entitled to an amount up to that portion of your net working capital, current assets minus current liability. Then comes the rather long-term loans, which are intercompany loans, loans between two companies, or loan between yourself and another company. The bank loan from the Bank of Switzerland is not an area bank loan. It will only be applied in the Switzerland headquarters. And there is, in this particular run, in this particular simulation, no possibility of a long-term bond emission. Total liability is of course the sum of all liabilities, current and fixed. Then comes the stockholders' equity. The two first lines are of concern to the headquarters again, the common stock and the paid-in capital. We will come back to this later in another tutorial. And then for a given area, we consider retained earnings, which are profits that have stayed in the company, that are reserved in the company, and the home office control, which is the amount that has been invested by your headquarters to help in the establishment and development of the subsidiary in the USA. The total of which will be 1.1 million, 1.2 million in this case. And then the total liability and equity is the total of liabilities and equities, and is a total of 1.572, which is the exact same number as for the total of assets, because, of course, by definition, a balance sheet has to be balanced.